Hey everyone, this is Matt Grossman from Barchart. And today I'm lucky enough to be joined by Ed Eglinski from Direxion ETFs. How you doing, Ed?
How are you today? Good to be here.
Good. I'm glad that you're here. Why don't we start out with this? Will you tell us a little bit about yourself and Direxion?
Sure. As you can tell by the hair, I've been in the financial industry over 30 years. I don't want to date myself. I've been with Direxion for 13 years. I head up our alternative investments and global sales for the organization. Direxion has been in existence for 25 plus years, is a top 20 US based ETF provider in terms of AUM. We're about 45 billion in assets, and primarily our firm has leverage and inverse ETFs. So we're primarily an ETF provider, but unlike most ETF shops, we have tactical trading tools, whether they're bull or bear, with different leverage points ranging from an inverse 1x bear to 3x bull and bear on the daily returns of broad indices. And as we'll talk about also, individual stocks in some cases.
And one of the things that I know about Direxion is that a lot of your ETFs are targeted for active investors.
That's correct. These are designed for short-term active trading. The word daily is even in the name of these leverage and inverse ETFs. We'll get into that, what that represents in a minute. But they should be monitored on a daily basis. So if somebody is not going to be focused on trading from a day-to-day standpoint, these are probably not the appropriate vehicles for them. These are not buy and hold vehicles or set and forget vehicles. These are for short-term active trading.
Great. Thanks for that information, Ed. So today, as you and I spoke about, there's a lot of things going on in the markets, the financial markets. It's not been a dull beginning of 2025 by any stretch of the imagination. So I'm excited to talk to you about a variety of different topics that everybody's focused on. Why don't we kick it off with interest rates?
Sure.
This is something that I know for the past couple of years, ever since interest rates went much higher than people were used to. People have been really focused on interest rates, wanting them to go lower. We had a bunch of rate cuts in 2024. In 2025, things are expected to go a little slower. The market's pricing in 2 rate cuts in 2025. So let me turn the mic over to you. What do you think's going to happen with interest rates this year? What do you think the Fed is looking at? Any and all color you can give us on that.
Yeah, our vehicles, we have bull and bear in the case of the 20-plus year Treasury and the 7 to 10 years. So really, for traders' purposes, like you said, there's a lot of volatility right now. So traders can take advantage of it in either direction, depending on the environment. Right now, so far in 2025, bond prices are rising, and that means rates are falling. The 10-year recently broke below key critical support at 440, and probably the next stop on the 10-year could be 4.25. The Fed, as you said, seems to be at a standstill right now with rates. Fed fund futures calling for 2 cuts this year, as you just said. However, I think the Fed's going to be more data dependent. The recent inflation data suggests that inflation is sticky still. But the wild card, as the Fed said in their last minutes, and they touched on it after the last Fed meeting, was the potential impact on tariffs. And that could really increase inflation and really curtail the Fed's ability to cut rates. You look at the job market right now, it's holding pretty steady, but there's signs of the economy weakening. We are seeing consistent inflows in our triple leverage bull 20-plus year Treasury, TMF. Some of you might be familiar with TLT. We use that for exposure. It is a daily vehicle that you want to look at in terms of it resets on a daily basis. So regardless of the interest rate environment right now, we see a lot of buying in TMF, the bull, for quite some time. We also have the bear, triple leverage bear, on the 20-plus year Treasury, TMV, for those that want to play the shorter end of the curve, the 7 to 10 year treasury, we have triple leverage bull and bear, TYD and TYO on that. There's always going to be short-term traders interested in the 20 plus year treasury. In particular, you go further out on the curve, longer duration tends to be a little more volatile. So that's one of our biggest funds, TMF, of the franchise right now. And you could trade off headlines, whether it's economic data, Fed meeting, or minutes. So these are tools that are very popular with the active trader when it comes to bonds.
Yeah, I was thinking the same thing. I personally, before some years ago, I was a professional trader, and you wouldn't always get the action that we're now seeing in treasuries. But not only are we having our monthly inflation numbers, but because of the headlines coming out of DC pertaining to these tariffs and the different countries, the tariffs and everything that's coming out of the White House, that we're getting significant volatility in the treasuries right now. So the ETFs that I know Direxion has can really be utilized by active traders to take advantage of this significant volatility that we don't always see.
Yeah, no, without a doubt. After the presidential election, you had rates moving a little bit higher this year so far, lower. I think that volatility is going to continue as long as there's directional trends. These type of short-term trading vehicles for active traders could take advantage of whether rates are rising or falling, as long as there is some trend.
Yeah, I agree. Well, Ed, thank you so much for your time. It's been a really insightful conversation, and we really appreciate it and hope that we can talk again soon.
Sounds good. Take care.